Ladies and gentlemen, welcome back to another explosive episode of Boss Economics World, where the gloves come off, and we take down the house of cards global governments are building with your hard-earned money. I'm your host, and today, we rip apart the facade behind January labor market data, the so-called robust payrolls, and the global recession-inflating disaster that your policymakers are so eager to dump onto your already strained wallets. So buckle up, this is systemic economic mismanagement at its finest. First stop, the good old US of A. The January 2025 payrolls number is projected at 170,000 new jobs, a number that's apparently supposed to make us forget about last year's disastrous chain of economic failures. But let's not lose the forest for the trees here, folks. Strikingly, 170,000 new jobs falls far short of trends seen just a year ago, dipping from the larger totals of November and December when economists cheered recovery from hurricanes and major strikes. But here's where things get truly spicy. Upcoming BLS employment revisions from March last year suggest that the figures have been massaged and inflated for a long time. The Bureau of Labor Statistics, BLS, indicates that payroll data through March 2024 was overstated by as much as 800,000 jobs. Stop and think about that for a second. The inflated numbers aren't just a statistical oversight. They serve a bigger purpose, to perpetuate the illusion that the American labor market is stronger than it really is. Now, the adjustments for business births and deaths since March, types of revisions that the BLS conveniently throws into the mix, further point to a moderation of hiring trends over the past couple of years. So, if you've been hearing that narrative about job creation being rock steady, it's time to start asking questions about whether those figures have more to do with paper-shuffling bureaucrats than with any real economic upswing. The revision, and pay close attention here, won't just affect sentiment but also the guiding data relied upon by the Federal Reserve. The Fed has been fixated on keeping rates higher for longer, ostensibly because of labor strength. Yet, when you realize that the numbers underpinning their assessments are woefully misleading, it becomes clearer that this growth is nothing but a mirage. The Fed, America's high priesthood of monetary management. Fed officials recently decided to keep interest rates unchanged, holding fire and waiting to see how the labor data reconciles with their ongoing battle against inflation. This no-action stance is starting to look increasingly like confusion. With inflation still simmering and wage growth stagnating, many are justifiably asking whether the Fed even has a clear strategy anymore or whether they're just playing a game of economic whack-a-mole. Look at Philip Jefferson, Michelle Bowman, and Adriana Kugler, the Fed governors who are out in Spinsville posturing about demand moderation, but are any of them actually hitting on the real issue? Namely that the Fed's own contradictory actions have boxed the economy into a corner. Too much rate aggression could crush labor, but letting inflation roam free will burn consumers alive. We've been sitting at an inflation rate far above Fed targets for too long, with interest rate hikes that are proving to be a blunt weapon rather than a surgical tool. The cumulative damage from high rates, their blunt force approach, has gone too far. But inflation isn't dead yet, is it? The Fed has stopped cutting for now, but resting easy when the inflation tiger is still prowling is a perilous move. But wait, that's not even the worst part. Let's pivot to the global catastrophe. They want to call it a trade war, but we'll label it what it truly is: economic insanity. Trump is back on the economic battlefield, folks. Just this past weekend, the president unleashed 25% levies on Canada and Mexico, and a good old 10% on China. A textbook example of a zero-sum game mentality at a time when neither the US nor global economies can afford to engage in a slugfest that directly hits consumer and producer prices. Sure, it may score political points, but let's not pretend like ordinary folks aren't going to feel it when import costs skyrocket and everything from groceries to electronics gets caught in the crossfire. Meanwhile, let's zoom out for a second. Canada, with its strong job gains, and Mexico, its economy hanging by a thread but still somehow staggering forward, are now in direct line of fire. Canada's cheap oil exports, particularly lucrative owing to Alberta's crude, have been keeping things going, but the thought of a retaliatory tax from Canada? Or Mexico? Trust me, it's coming. And you know what that means: higher costs across borders, which will eventually filter down to you, the consumer. And what does trumpeting tariffs do for anybody, really? Sure, it may inflate nationalistic pride for a few, but this is how you accelerate a global recession, plain and simple. And don't even get me started on China, which is already showing signs of contraction. Do we really need the second largest economy in the world facing additional hurdles to production? Further proof that the global elite seem intent on pressing the implode button on the world economy is just one small segment of this vast economic theater. Let's take a walk to other parts of the globe. How about we travel across the pond real quick? Have you paid any attention to the European Central Bank lately? Maybe not, because the news loves to focus on America, but rest assured, Europe's economy is potentially even closer to a breaking point. The ECB just rolled out its fifth rate cut, but in what universe is their easing policy truly making things better? Eurozone inflation sits a tad under 2.4%, and we've got services inflation in the UK still more than twice the 2% target. That's a 1-2 punch of sticky wage price spirals that central bankers seem to have given up battling comprehensively. More rate cutters will join the bar crawl: Sweden, Poland, Kenya, just take your pick. Central banks everywhere are easing even as inflation in some places like Turkey is eye-popping, with projections only softening toward 21% by year-end from a current 40% plus. Insanity. And that brings us to industrial giants like Germany, where not only have they been grappling for years with an industrial slowdown, but Chinese imports are now down, yet another casualty of global unwinding. If Germany's factory orders for January continue to slip and its infamous trade surplus with the US keeps shrinking, does anyone remotely attach hope to a recovery? Or just more deepening stagnation for years? Meanwhile, everyone's eyes are on January job cuts from Iceland to the UK, where wage negotiations are spiraling beyond control. You want a recession recipe? Stubborn inflation meets rising unemployment, and you've got a party starter right there. Make no mistake, it isn't just Western market economies backsliding. Look at Japan. Wage data is on the horizon, ready to underscore how labor's voice isn't being heard loud enough despite Abenomics in the rear view and more demands for higher wage growth. Across Australia, Thailand, and Vietnam, industrial production stats are sounding mild alarms, while governments slash rates like it's going out of style. 2025's supposed to start on a high-growth note for many, but we're seeing factories across South Korea and Indonesia pull back thanks to lower external demand and higher capital costs. And let's not forget India embarking on its easing cycle with a rate cut to 6.25%, and has anyone noticed wage growth, where Indian wage labor participation has hit highs right while inflation's still hot? Doesn't this smell like déjà vu from the prior taper tantrum of 2011 to 2013? What we're witnessing is a global financial system on life support, with policymakers gambling on every side: tariff wars, inflation blunders, misguided interest rate moves, all while piling debt to unimaginable levels. They may claim that their hands are on the churning wheels, but the truth is simpler: the train's derailed, just no one wants to tell you yet. Inflation still haunts household budgets from Seattle to Poland. Labor markets, supposedly the glowing stabilizer, show nothing but cracks upon cracks, once the real job numbers are revealed. Global trade wars and tariffs will only increase production costs, hitting consumers even harder. And the rate cutters club, well, it'll soon bleed public pockets dry while doing little to alleviate recessionary forces. Folks, it's high time more light got shed on the underlying ominous moves simmering behind central bank doors. Revisions? Another smokescreen. Soft landings, utter fantasy. It's an economic repeat of 2008, but this time, they can't promise a fix. Are you prepared? That's all this time, economics bosses. Share your thoughts below. Let me know if you're as enraged as we are by this government and central bank miscalculation. Don't forget to like, subscribe, and catch us next time at Boss Economics World, your #1 stop for economic sanity in an insane world.